30 key takeaways from chapters 13 to 15 of The Psychology of Money by Morgan Housel, with each point illustrated by a real-life example or story to help bring the idea to life. Chapter 13, Room for Error. 1. Margin of safety is essential. Takeaway, always leave a buffer in your financial plan to absorb unexpected shocks. Example, many investors keep an emergency fund, money set aside that protects against job loss or medical emergencies, even when markets look promising. 2. Prepare for the unpredictable. Takeaway, no plan is foolproof. Expect that things won't always go as planned. Example, a homeowner with a contingency budget can cover sudden repairs without dipping into retirement savings. 3. Avoid over-leveraging. Takeaway, taking on too much debt can eliminate your safety net and risk your entire financial future. Example, the collapse of highly leveraged firms like Lehman Brothers shows that overextending can lead to disaster. 4th, diversification acts as a safety net. Takeaway, spreading your investments across different assets reduces the risk of any single failure derailing your portfolio. Example, a diversified portfolio that includes stocks, bonds, and real estate helps many investors weather market downturns. 5. Conservative assumptions protect you. Takeaway, planning with cautious estimates, assuming lower returns, builds in room for error. Example, a retiree who plans on a 3% return rather than a 7% return avoids falling short when markets underperform. 6. Avoid single points of failure. Takeaway, don't rely on one income source or asset, spread your risk. Example, a professional with multiple income streams, side gigs, investments, and a salary is less vulnerable to an economic downturn. 7. Buffer supports long-term growth. Takeaway, a margin of safety allows your investments the time to compound even through rough patches. Example, an investor who refrains from withdrawing during market dips benefits when the market eventually rebounds. 8. Room for error reduces stress. Takeaway, knowing you have a cushion provides peace of mind and prevents panic during volatile periods. Example, families with a well-funded rainy day fund remain calm when unexpected expenses arise. 9. Planning should factor in uncertainty. Takeaway, build flexibility into your plan by considering a wide range of outcomes. Example, financial planners often advise clients to set aside extra funds for unforeseen events like sudden medical emergencies. 10. Adjust your safety margin over time. Takeaway, as your personal situation or risk tolerance changes, so should your margin for error. Example, a young professional might initially take more risk, but as they age and family responsibilities grow, they increase their savings cushion accordingly. Chapter 14, You'll Change. 11th, expect personal evolution. Takeaway, your goals and desires will change over time. Your financial plan should be flexible enough to evolve with you. Example, a person in their 20s might focus on wealth accumulation, but as they approach retirement, their priorities shift to preserving capital and enjoying life. 12th, revisit your goals regularly. Takeaway, periodically reassess your financial objectives to ensure they still match your current needs and aspirations. Example, annual financial reviews help a couple adjust their savings plan after starting a family or changing careers. 13. Avoid extreme commitments. Takeaway, extreme financial decisions based on current desires can lead to regret later when your needs change. Example, overcommitting to a high-cost lifestyle in your 30s may force a difficult lifestyle adjustment in retirement. 14. Balance, present needs with future flexibility. Takeaway, it's important to enjoy life now while ensuring you have room to adjust for future changes. Example, an individual may budget for both short-term pleasures, like vacations, and long-term security, saving for retirement. 15. Accept that your risk tolerance will shift. Takeaway, what feels comfortable risk-wise at one stage of life might feel too aggressive or too timid later. Example, A young investor might favor high-growth stocks, but as they near retirement, shifting to more conservative investments becomes prudent. 16th plan for different life phases. Takeaway, design your financial strategy to accommodate the different priorities you'll have at various stages of life. Example, someone might allocate funds for education and career growth in early adulthood and later focus on healthcare and leisure in retirement. 17. Avoid getting locked into a single plan. Takeaway, rigid financial plans can become misaligned with your evolving circumstances. Flexibility is key. Example, a business owner who revisits their investment strategy every few years can adjust to market changes and personal goals. 18. Embrace the end of history illusion. Takeaway, understand that you are likely to change more in the future than you expect. Plan with that in mind. Example, rather than committing to an extremely frugal lifestyle, a balanced approach allows for future lifestyle adjustments. 19th, design for moderate, sustainable growth. Takeaway, moderate annual savings and realistic income expectations help prevent future regret. Example, a balanced plan that targets steady, achievable goals can prevent burnout and dissatisfaction later in life. 20. Flexibility is as important as discipline. Takeaway, while consistency is important, the willingness to adapt to new realities is equally crucial. Example, a person who shifts from aggressive to conservative investing as their priorities evolve demonstrates adaptability in financial planning. Chapter 15, Nothing's Free. 21. Every choice has a cost. Takeaway, every financial decision, whether saving, spending, or investing, carries hidden costs in the form of volatility, uncertainty, or sacrifice. Example, accepting market downturns as the price of admission for long-term gains reframes short-term losses as part of the process. 22. Understand opportunity costs. Takeaway, recognize that spending money on one thing means not spending it on something else that might offer more value in the long run. Example, choosing to invest in a retirement account rather than spending on an expensive vacation can yield greater future security. 23. Hidden costs are real costs. Takeaway, not all costs are immediately visible. Psychological stress and reduced flexibility are part of the price of financial decisions. Example, the stress of managing a volatile portfolio can be viewed as the fee paid for the potential of high returns. 24. Volatility is the price for high returns. Takeaway, accept that market fluctuations are inherent to investing and treat them as the cost of doing business. Example, long-term investors in index funds view market dips as temporary fees that allow them to stay in the game for future growth. 25. Nothing worth having is free. Takeaway, every worthwhile financial outcome requires sacrifice, whether in the form of patience, discipline, or risk. Example, building a successful business often means long hours and initial financial struggles before reaping the rewards. 26th plan for the emotional costs. Takeaway, understand and accept the emotional toll that financial decisions, especially during downturns, can take. Example, an investor who prepares mentally for market corrections is less likely to make panic-driven decisions during volatility. 27. Cost of inaction is also a cost. Takeaway, failing to act, such as not saving or investing, has its own hidden costs in terms of missed opportunities and diminished future freedom. Example, delaying retirement savings even by a few years can significantly reduce the benefits of compounding over a lifetime. 28th, be willing to pay the price of patience. Takeaway, long-term rewards often come with the cost of waiting, which requires discipline and emotional fortitude. Example, investors who stick with their plans through market cycles often find that the patient fee of enduring volatility is more than repaid by later gains. 29. Every investment has trade-offs. Takeaway, recognize that high returns usually come with higher risks and other sacrifices. Balance these trade-offs carefully. Example, A tech startup may promise enormous growth, but also carries the risk of total loss. Diversification can mitigate this trade-off. 30. Accept costs upfront to succeed long-term. Takeaway: embracing the inherent costs of achieving good investment returns, volatility, uncertainty, patience, prepares you to make decisions that yield sustainable success. Example: a disciplined investor who accepts short-term losses as part of the journey is more likely to achieve long-term financial independence. Nure. These 30 key takeaways from chapters 13 to 15 of The Psychology of Money demonstrate that successful long-term financial planning requires building in buffers, room for error, planning for personal evolution, you'll change, and understanding that every financial decision comes at a cost. Nothing's free. Real-life examples, from maintaining emergency funds to accepting market volatility as the price of admission, illustrate how these principles apply in everyday decisions, ultimately guiding you toward a more secure and balanced financial future.